over. Federal Reserve leaving interest rates unchanged yesterday, citing worries over global growth. I want to bring in Charles Schwab, fixed income strategist Kathy Jones. Kathy, good to see you. Thanks for joining us.
Thanks for having me.
You were not surprised by the decision. What's the move now? What are you telling clients?
Well, we're telling clients that there's still a good chance of a move by the end of the year, but it could easily be pushed back. And we're watching the dollar and credit spreads. Those are the two things that we're keeping an eye on. Credit spreads have been widening, meaning more risk in the market. And, of course, the dollar has started to pull back, which is a good thing for us in terms of getting the inflation numbers better. So we have a big drop in import prices as the dollar moved up, and if the dollar stabilizes or pulls back, then that will reverse.
Savita Subramanian, Bank of America, Merrill Lynch, you joined me yesterday right after the decision, and it could have gone either way, right? But we saw that they did nothing. Yep. What concerned me was the fact that they talked about the global economy and the slowdown, because that's the fundamental for investing in equities. How do you see it?
Yeah, I mean, it was interesting to see the market's reaction, because it was almost so bullish, it's bearish. That's the way I interpreted this, is that, more liquidity, which has historically been good for equities, but now more liquidity because of weaker global growth. I mean, this doesn't feel great.
So bullish because rates stay low and you have to go into equities.
Accommodative policy, there is no alternative, like the whole argument we've been hearing for the last 6 years. But it's kind of like, how long does this story go on? And, I thought that the best sign for risk assets across the globe would be if the Fed actually raised interest rates. We thought that would be actually a bullish sign for equities, because that suggests we're kind of in normal territory. We're on the road to normalization. This is just more of the same sort of purgatory, unclear growth trajectory. I think the same stuff is going to work, namely high yield, high, secular growth stocks. But it was interesting. I mean, it's almost like we're at the other side of how much liquidity do you need before it gets to be almost too much.
And we're talking so much about when the Fed will raise rates. Now we finally know they're not raising rates, Kevin. But what does this do? It opens up total uncertainty until the rest of the year. Isn't that right?
It's uncertainty, and also I think it's very disappointing. I think the Fed is at risk now of losing credibility, because if there is another shock, they don't have the tool to react to it. But I agree, we're in this purgatory. That's a good word for it. And it just reminds us every day that this is an accommodative policy for a crisis environment. And I think that what's going to happen in the long run, we're going to see this as distorted capital formation, distorted capital allocation within the economy. I do think that yesterday also makes the case for the Fed is reacting to the capital markets, not to the underlying economy.
Yeah.
And later on, I was very, very disappointed, because it just seems to me like there's a lack of courage. It's going to be disruptive on some level. Even do the 10 bips to say it's over, the accommodative piece is over, and just let that work. And we all know stocks can work in rising rate environments. We've seen it before.
And really, how big of an impact would have a quarter-point move been? I mean, the truth is, we're talking about 25 basis points. Right after the reaction, my big concern was about growth and what does the fundamental backdrop look like. I joined Lou Dobbs, Stuart Varney, and Neil Cavuto yesterday to talk about where investors are looking now.
Within an hour after a Fed move, and even an unexpected move, it moves about 3.5%, one way or the other. And it settles the day within 1% from its prior close.
That's an expected move? Is that what you said? Of unexpected?
I don't know. Of the last dozen.
I think it's worth looking at some of the growth areas. What is down in this market? Technology. Okay, banks, industrials. The growth areas of the stock market are down. Where's the growth? And, of course, what did well, Savita, were utilities, real estate investment trusts, and yield-sensitive areas.
Right, exactly. Utilities finished the day, best sector. Kind of what we're used to, high yield or biotech, really just, kind of shorting the economy and buying either scarce growth or high yield. And I think we're kind of in that purgatory, more of the same, stick with what's been working for the last 6 years. But I have to say I was disappointed by the lack of any sort of lift off.
Because you wanted to see confirmation that, in fact, the economy is moving forward and growing. But China, Joe, has been one of the big issues.
And I thought it was so interesting how Chair Yellen basically said that they would be watching China directly and looking at that data coming out. And yet that is data that cannot necessarily be trusted on a broader scale, right? And you also have, of course, other countries potentially dipping into recession. But it seems that the Fed is now wanting to be a little bit more data dependent on China. And that is a little bit interesting because it indicates that they don't feel necessarily in total control.
Right. And the data from China is
sketchy.
Big question mark.
Yes. I mean, it's clearly slowing. Kathy Jones, final word from you in terms of investment strategy now. What are you telling investors?
I think the biggest mistake fixed income investors have made over the past several years is to keep short duration. You easily have to be intermediate term duration. You can't sit on the sidelines and wait for rates to go up. It's still a long way ahead.
All right, we will leave it there. Kathy Jones, great to see you. Thanks so much for joining us. Moving on to the top story in the Wall Street Journal this morning, Walmart announcing plans to hire 60,000 seasonal workers for the coming holiday rush, matching last year's level. This is after Target said it would hire 70,000 employees, and Toys R Us is reporting that it plans to hire 40,000 people. That is down from last year. It seems like good news to see this kinds of hiring, but again, this is temp work, and it's not benefits, Savita. I mean, this is really just for the holiday rush. Question is, are we going to get a holiday rush? We're still waiting for the consumer to put money into the economy. Oh,
that's the other eerie phenomenon. This recovery has been very good for Wall Street, but it hasn't been so great for Main Street. I think the consumer is still feeling a little gun shy about spending this windfall of savings from lower oil prices. We've been talking about the consumer sector. We're not big fans of consumer discretionary stocks. I think, if anything, if we are going to see more hiring, that's bad for margins of the big retailers because they tend to be more cost dependent on workers rather than, they don't necessarily see this top line uptick. But I do think that it's interesting. We haven't seen that resurgence of consumer confidence, despite the fact that oil has been cut in half from its prior highs.
As consumers have started to spend, what's been sort of the opposite in this recovery is they've spent more on durable goods, on big ticket items, which is usually they start buying the retail, the clothing, and we haven't really seen that. For the first time in our framework in a few years, we're starting to see the mid-tier consumer cyclical type names come up as being something worth looking at, not necessarily the high end. But we had the auto sales doing really well. We had people putting things back in their homes again. I think that the one, and it's a low probability, but the thing to look at as a potential bullish sign or areas in the market over the next 12 months is, do we see any indication the consumer starts to spend? So when we get the back to school data, when we get the holiday data, I think that's going to be very, very important. But the buying all these temps gets to the larger issue. There's so much underemployment. There's so many people on the sidelines. The chair said it again yesterday. There's people that just are not coming back.
Right. Well, when you look at the participation rate, I think, Joe, it's 38% of working age Americans are out of a job and are not interested in it. They're not looking for a job.
Yeah, it's late 1970s lows, and that has stayed the case over the last couple of years. It really hasn't moved. And what I'll be watching in the holiday season and in the back to school shopping season is how are people shopping differently too, and how are these companies restructuring, because some of these seasonal hires actually may change if more and more people are shopping online, right? So you're looking at a kind of a different landscape potentially.
We'll take a short break.